So this is Pria Bakhshi. She's a very old friend of mine, and she's been very, very gracious in agreeing to come on here and talk to us a little bit about interpersonal skills from the perspective of Goldman Sachs and of her job on a trading floor. So I'll let you introduce yourself.
So as Arjun said, I've known him for a long time. But in terms of my personal background, I've been at Goldman for 4 years now. I'm an associate in the sales division. So on a sales team, and obviously, as you can imagine, interpersonal skills play a big role in that kind of seat specifically. Aside from that, in terms of background, I interned at Goldman both spring and summer. I studied economics at LSE, which some people say is a bit of a banking factory, but I would highlight, given the context of this is sort of recruitment, you don't need to be in that kind of seat to be able to get a job at somewhere like Goldman. I work with people who have a very huge range of backgrounds, and while I may have the kind of cliche economics then banking, internship then banking background, it doesn't have to be like that. Arjun, anything else I should highlight or go to the next question?
Yeah, I mean, the next question I was going to ask you follows on pretty naturally from what you were saying. What does your typical day look like now that you've been there for 4 years? And a follow on to that is, does it make any difference what you studied now that you've spent that time there in terms of what you're actually doing? I know there's sort of two questions, but you made me think of both of them at the same time.
So I'll actually take your second question first. I think it's a good point to make a distinction between whether what you studied helps you initially or once you've been there 2, 3, 4, 5 years. And I think at first, it probably helps having some kind of quantitative or economics-based background, only because if you're in a technical seat, then obviously it's much easier to pick up the concepts quickly. But within the trading floor, there's a huge spectrum of roles. Obviously, there are sales, trading, and research, but within that, there are many different asset classes, some of them more or less technical than others. So having studied econ helps me in rates, which is what I do because it's a very macro product. You need a good macroeconomic understanding. It's also a very technical product, so you need a good quantitative background. But if you were in another area, which is maybe less mathematical, you don't need the same background. 4 years on, I think no one cares what you studied, no one cares where you went. What really matters is you're learning on the job in those 3 or 4 years. And that's something that's very apparent in the recruitment process as well. When we intern, or when we interview for the internships, and then when we take interns, we care much more about people's potential to learn and pick up new concepts quickly, learn technical aspects of the market very quickly, rather than actually having the knowledge already. What matters is how quickly you can actually learn it, rather than coming straight in and saying, I know everything, from day one. So I hopefully that answers your second question. On your first question, now that I've been there quite a bit of time, now that I'm an associate, I'm not a grad anymore, obviously, there's much less admin to the day. So my day starts quite early. It starts at 6:45, or now probably a little bit later, realistically, but it should be 6:45. On my way to work, check my BlackBerry. I check any emails overnight on market moves, market color, either internally and also from news sources such as the FT, obviously, Bloomberg, Reuters. When you join any kind of trading floor role, you get a huge amount of information to your email. And it's difficult to filter through all of that, but you learn how to actually do that. So I start by going through what's relevant to me, what's relevant to my clients. Then I actually get to work, and we have a morning meeting. So we discuss with all of our different trading desks what's relevant to them from the previous day's trading, what they think is important for the next day, so the coming day. What are important themes? What are trade ideas that they're looking at? What are big macro themes that they're looking at? And then basically from then on, it's very much client focused. So calling clients, making sure that I know what they're looking at, making sure that they know what's relevant to us on a given day, but also over a more medium-term time frame. And then for me personally, I'm in what's called a flow sales desk. So the deals that we work on are not long-term structured projects, but we cover among others, we cover hedge fund clients. So it's very, very much sort of quick, fast reacting to market moves. We do a lot of execution for our clients. That's probably what keeps us busiest when we're not actually calling them or talking to them about trades, talking to them about the market. And then aside from that, we obviously spend a lot of time actually meeting clients in person. So client meetings with either just one-on-one with the client, because it's very important to build a personal relationship with your clients. But then also a big part of what you do is deliver the firm to a client. So you make sure that they're in touch with our economists, you make sure that they're in touch with our traders, you make sure they're in touch with senior people from the division. And that way you deliver not only your own views and your own sort of niche of the market, but the whole firm to the client. And then next day you start the whole thing again.
That was a very comprehensive answer. It leads me just to one question about, we're talking about ability, right? We're talking about a skill set that you might not have, as you mentioned, when you get in there. I've definitely got the impression from speaking to 30 or 40 recruiters and hirers within this space that they're sick of candidates coming in thinking they know everything already and having studied too many maybe finance related vocational degrees, and it's probably better to be that unpolished diamond, as it were, especially somewhere like Goldman Sachs. But maybe you can talk about this in when you started and now, but what do clients expect from you in general? What do they expect you to be able to do? And that's maybe a very abstract question, but it's actually, yeah.
I think that's quite hard to answer. But it definitely depends on the stage of your career. So obviously very early on, all they expect you to do is make sure that everything runs as smoothly as possible for them. So when you're a junior, when you're brand new on the desk, well, firstly, you may not have that much client contact, but when you do start to get that, then it's, a lot of it is sort of post-trade work. So making sure from a processing perspective, everything is very smooth for them. There are no issues, there are no bumps. Honestly, that's not the most interesting thing to talk about. So when it gets more interesting is when you're a little bit more senior, when you, even if you don't have your own clients, when you have much more client contact, then they expect you to, well, firstly, like I said, a big thing is delivering the firm to them. So especially if you're, say, only 2 years in, a 50-year-old hedge fund manager isn't going to care what you think about the market. So what they want from you is, what do your senior traders think? Can you put me in touch with this person? Can you get me a meeting with your head of European research? Or if not that, then can you very coherently talk about the views of, in my case, Goldman Sachs? And that means research, so official views, but also trading, which obviously changes a bit more often. Then as you get more senior, they want to be able to have a conversation with you about markets. So they don't want it to be one way. They don't want you to be only telling them, this is what I think, this is what we think, and then kind of shutting down the conversation. They also don't want you just to listen to them, because then they feel like they're just giving everything, they're not getting anything back. So really what you want, the aim is to be able to have a very sort of high quality discussion with your client about markets, where you can bounce ideas off each other, whether it's ideas about which way the market is going, or if you agree on a view, or if the client has a specific view, ideas about how they can actually express that in whatever your product class is. Then a big part of what we do, moving on from that, is actually structuring trades around clients' views. And that's when it gets interesting, because depending on which area you're in, there's a big spectrum of ways in which you can express a view on a specific theme. And as you get more comfortable with the market, then you get better at having those conversations.
It's really fascinating what you said about how you have to absorb views and methods, I suppose, from various parts of your bank, whether it's research, might be more long-term, or an intraday view from one of the traders you're probably sitting quite close to. Would you count as a skill the ability to filter through? Well, I'm sure there is more than one opinion within a certain, especially when you have a sort of volatile week, or a situation where people are uncertain. You don't just have a sort of homogeneous, uniform view that you then regurgitate to your clients. And as you said, they're also going to have their own opinions. So how do you manage, just elaborate a little bit more, how do you manage like multiple opinions and the diplomacy that comes with that?
I think that's a really good question. And that kind of, in a way, that goes back to what I said when you asked me about the structure of my day. Because again, there's a big part of filtering out from the huge amount of information that you get. It's really information overload, what is relevant to you, but also to clients. So when it comes to communicating views internally to clients, well, what first thing matters is whose view are you talking about? If you have, even within one trading desk, say, for example, the government bond trading desk, the junior guy may say one thing, but the senior guy may say something that's the complete opposite. And the client is always going to care, unfortunately, whoever's right or wrong, the client is going to care what the more senior guy thinks. So I guess that's kind of a very easy way of filtering out, views. But then the difficulty is, and this has actually happened quite a lot in rate space recently, when your economists say one thing, for example, our economists were predicting that bonds should reach above 1% by the end of this year. They've since revised this down, but at the time, that's what they were calling for. Whereas our traders, and this was at the start of QE, were saying, no chance, bonds are going to close to negative, or close to zero at least. And then you have a situation where you have clients saying, what does Goldman think? And you have to figure out, well, we have two completely opposing views, and how do you actually communicate that to the client? But I guess, again, the biggest thing is clients will have their own opinion. So what you can do is just provide them with as much information as possible. And it's very easy to forget that sitting in a bank, as I said, you're bombarded by information. But if you're a client, if you're a portfolio manager at a hedge fund or an asset manager, you're sitting on a completely silent trading floor all day long, and you don't have the same information flow that we have the luxury of having in a bank. So there is a certain degree to which you have to filter out views that you get internally. But when you have a sense of who is important to listen to, who do the clients care about, then regardless of whether they agree or disagree, you just have to kind of be able to deliver that diplomatically, whether it is in agreement with each other, in agreement with the client, in agreement with your own opinion. You kind of have, it's a bit of a balancing act.
What percentage is your own opinion? I want to hold you to it.
Client, you mean?
Your own opinion on behalf of the client. I mean, obviously, like you said, you're managing multiple views, and you counted your own opinion as one of those, which is quite interesting. Do you have faith in your own ability to sense what's going on, and sometimes ever like not override, but lean towards one way or the other, based purely on what you've assessed, as opposed to just like the hierarchy or something like that?
I think so. Obviously, a few years ago, that would have been, I would never have even mentioned my own opinion. I would just say, oh, well, our chief economist thinks this, and my head of trading thinks this, and Goldman doesn't think anything else. That's it.
Yeah.
After a few years, when you have, and even 4 years isn't that much experience, but when you have some experience of the market, and you've had a chance to validate your views and your analysis, then I'd say maybe in terms of the weight that I stress on each of the different views, I would give mine probably 30%, or maybe 20%, and then the rest is equally split between trading and research.
That's a good conservative kind of estimate.
Depends on the asset class, the market, the context, but that's a rough.
Absolutely, and we'll actually talk about a bit later about how different asset classes affect each other in a general sense, and also in terms of how that affects your day job. And something, as we saw this week, something ostensibly happening in the commodities market that had a big effect on fixed income space. People might disagree with that. That's certainly what the FT was trying to put forward as the main reasoning behind it. I'm going to just go to answer some of the questions that have come through our chat, even though this particular topic is fascinating because it relates a lot to our technology and our platform. So let me just find that. So Eduardo has asked, which I think was quite a predictable question, but nonetheless a good one. What's the most difficult question that you were asked when you were going through the application process? And also, was it related to your interpersonal or to your technical ability, which is interesting as well?
That's a really good question, and obviously relevant. So actually, I would pick two, and there's sort of one from each. So one is sort of maybe not interpersonal skills, but soft skills, and then one is technical. So in interviews, you get a lot of what we call competency questions, which are not about your technical ability, but about your leadership skills or soft skills, including interpersonal skills. But I think the hardest one was, what is your biggest weakness? Because it's really hard to answer that question in a way that, obviously it is an interview, so you don't want to highlight a flaw in your abilities or your character, but you have to answer the question. So it's a really tough balancing act to give an honest answer, but one that actually makes you look good at the same time. So for anyone who's in the application process, give that one a lot of thought. And then on the technical skills side, this was a bit out of left field. I got asked if a technology was invented such that you could snap your fingers or go into a room and you could be transported anywhere in the world within seconds, what would you invest in and why? And that's obviously, in a way, that's about technical skills because it's sort of relating back to the market, but it's not a standard kind of question, or not like you have $1 million, how would you allocate it to different investments? This is a really wacky kind of scenario, and then which parts of the market do you think would be most impacted by it? So I think those are probably the two hardest questions.
I like that question.
Yeah, it's a tough question, no?
It's got me thinking. I just want to say, I've asked the former question that you mentioned, just parroting what I'd been asked myself when I was on the other side of the interview table. And I'm yet to get a good answer to that. Sorry if anyone I interviewed is listening, but I always get things like, I'm a perfectionist, and you just think...
I think I use that one.
Well, in your case, it's true, but in many cases I could...
it's clearly not.
See that it wasn't the case. But yeah, I think there's as you said, that's a tricky one. I think just on that subject of interviewing, as I mentioned, we've been gathering a lot of feedback from various banks, various levels of seniority on, what they're looking for in their interviews. And something I've heard so many times is, you know what, in 20 minutes, anyone can pretend to be likable. Anyone can pretend to be polite, or rather, just come across as really angelic. But that says nothing of how they'll end up being when they're actually in that, the stressful environment of a trading floor, and then needing to collaborate with people that they might be competing for a promotion with, really very much more deep indications of their personality. And I wonder, where do you think it's going in terms of, just that interview, that face-to-face kind of process of understanding their fit and their compatibility? Do you think it's going to stay the same, or do you think there's going to be different activities and different processes in the future?
I think there need to be different processes. What we find is, obviously, the bulk of our recruitment comes through the internship program. But it's very hard, as you said, in a half hour, even if you have multiple interviews, in a half-hour interview to actually measure someone's interpersonal skills. I do know that some banks have, as well as having the interviews, they have, for example, they'll have a whole day assessment center with group projects and group presentations, and that's, again, a small way of testing that. But it is, again, only one day. You can't really measure how people react to stressful scenarios, how people will react to being under, a very competitive scenario. Obviously, a one-day interview process is that, but then a 10-week internship is sort of back to the nth power. So I think there is a need for recruiters to have some kind of alternative platform to test people's interpersonal skills, but it's not really clear yet what's the most effective way to do that. I mean, you probably have a better sense of that than I do, I think.
No, absolutely. That's what we're trying to work out. And there's another question that's come up, which is very interesting, and it touches upon something I mentioned earlier. Sam's asked, how many different markets do you have to keep track of yourself? And are you focused on just a specific one? And I suppose the second part is, does this create busy, high-stress times in the day, which I guess he's referring to, where events will happen that affect multiple markets at the same time. There'll be like a confluence of activity across different areas. You told me earlier yourself that you know more about FX than you do about commodities, for example. Definitely, I'm sure the audience would like to hear more about that.
So for me specifically, as I said, I'm in interest rate sales. So rates are, although it sounds like it's kind of quite micro, quite technical, it's actually one of the most macro product areas. So what that means is it's incredibly impacted by what happens in other asset classes. So I completely agree. I need to be very focused on what happens in FX, as you mentioned, also equities, commodities to a lesser extent, unless there's a very big move in gold or oil, and that'll usually be driven by some kind of macro factor. Then commodities can be a little bit more micro sometimes. It's very much more supply and demand driven. But in our seat, in any kind of macro sales or trading role, you have to be really aware of what's happening outside of your home market. Because they're also interconnected. When there is a big macro event, like you said, Arjun, it's going to affect every market in some way, shape, or form. And actually what can happen is even if the macro event itself should have a sudden effect on rates, so it should cause rates to go up. What happens in equities or FX may actually have such a big effect on my market that it has the complete opposite effect to what was intended or what was expected by a certain data point or macro event. So to that point, we have to be incredibly on top of what happens outside of, say, just fixed income. We use Bloomberg and we're very dependent on platforms such as Bloomberg, because that allows you to have an interface which has, for example, I have screens which have, maybe 6 or 7 different rates products, but then maybe half of my screen is taken up by 3 different equity indices across Japan, the US, and Europe, actually also the UK, then also a whole commodities sort of platform, then which is gold and oil mainly, and then also different FX markets. Because within interest rates, we also don't look at just US Treasuries or just German fixed income. If you're in what we call G10, so basically non-EM rates, it's anything from European markets to Aussie markets to Japan to obviously Europe, and then within Europe there are many different ones. So each of those will be differently impacted by what happens outside of interest rates as well. So it's a very broad spectrum, and that means that when it's busy, it's incredibly stressful to keep on top of what's happening everywhere. But I guess it's frustrating to hear, I know, but you kind of get used to that as you spend more time in the seat.
Yeah, absolutely. And dealing with pressure is another frequently cited ability. Might fall into the category of a soft skill because it's hard to measure. That I've heard from the customer development we've been doing, and it's probably the one that we have struggled the most to conjure up a system of measuring that can exist in a browser, as it were.
And it's incredibly important because, especially if you're in a flow state like mine, meaning something that's very fast paced and you have to react very quickly to markets. And also sort of when you've got clients bombarding you with either pricing requests or phone calls or whatever it is, it's quite bad that there isn't really a good way of measuring that in the recruitment process, because you end up hiring people who seem really good on all other metrics, and then you put them in the seat and they just fall apart under pressure. So if
that happens even more apparently in some types of hedge funds, where people just have no ability to lose money, and they can't sleep. Yeah, they can't sleep. They start doubling down. They start acting crazy. It's as you said, I think both buy and sell side, very difficult to anticipate in advance whether they're going to be able to deal with it.
And I think for the applicants, that's something to think about. You need to do a lot of introspection and figure out, can I actually deal with that kind of pressure? Because also you don't want to end up getting hired to a seat where you are put in those sort of situations and then you fall apart. I mean, as frustrating as it is for the bank, it sounds bad, but there are so many applicants that in a way, if someone can't deal with it, it's okay. There'll be someone else to take their place. But as an applicant, if you get a spot and they're quite hard to come by, you want to make sure that you position yourself in the best place possible. So maybe, Arjun, for you guys, that's something to think about, is the people who use your platform, they should have a way of kind of maybe some sort of self-assessment or self-ranking, as opposed to it being only from the recruiter side as well.
That's a very interesting idea. And it would also give us a lot of information on how honest they are with themselves. And
that's the hardest part.
Or conversely, how deluded they are. which is not a quality that I think any any industry is looking for, besides maybe acting in Hollywood. Maybe, I don't know, just just off the top of my head. Okay, there's an interesting question which is similar to one I was planning to ask as well, which is, can you describe the team that you're working with? The question I was going to ask was, what does collaborative, which is another really important quality, mean in the context of a trading floor? I guess you can answer both of those together. Like, what's your team like, and how do you collaborate with them? What does that really mean in a bank?
On a trading floor, being able to, so I guess collaborative is kind of the other side of the coin of being a team player. And being able to work in a team is probably one of, aside from the obvious things like technical skills and interest in the market, being able to work in a team is probably the single most important skill that you have to have. And I think a lot of things come under that umbrella, because it's sort of obviously working well with people, but also good communication skills, good prioritization skills when different people, whether it's internally or clients, are bombarding you with things that need to be done or questions that they have. And it's super important because, especially as a salesperson, you're kind of the fulcrum between trading, and then on the other side is the client. And in a way, there's a bit of a conflict of interest between those two sides, and you're the person who has to manage those differing incentives and priorities, and also make sure that you get collaboration from your traders to give your clients the best pricing or the best information, and from your clients also to give the best, basically give the best trades or market information or execution to your traders as well. And also in the middle of all that, protecting the firm from not losing any money, but also protecting the client and making sure that they get the best pricing possible. So being able to, that's kind of on a bigger picture version of collaboration, I think. So being able to manage a lot of differing incentives, a lot of different priorities, and making sure it all works smoothly together. But then, like you said, collaborating within the team is really important too. And it's funny you should highlight that, because actually that really was really driven home to me yesterday, because we have two analysts on my team. One has been at Goldman about 2 years, the other one recently joined about 6 months ago. And so they, as you can imagine, they're the two juniors on the desk. They have a lot of shared work. And what I notice is actually the level of tension between the two of them is terrible. And it's a big problem, because when you have a lack of collaboration within the team falls apart. It doesn't function properly. People don't respond well when they're given work to do. People don't actually do the work as efficiently as they would otherwise, because they're too busy being pissed off at someone for something. So being able to create the kind of environment where people work well together is probably one of the most important things. Then about my team specifically, having said that, generally I think my team is awesome. I mean, on the whole, everyone gets on very well. It's a team of, we have one MD, one VP, 2 associates, and then the 2 analysts who I mentioned. And it's, on the whole, aside from sort of the blip we had yesterday, it's a very well working team. Everyone gets on very well together. I think we're lucky that everyone's very sociable, everyone's very friendly, everyone wants to create a nice working environment. I've been in previous teams at Goldman as well, where it has been the opposite of that. So very successful teams in the sense that they make a lot of money, but then the actual environment on the desk is much more, I don't want to say cutthroat, because that's sort of the catch-all term for anyone in banking, but it's a more difficult environment. So I think you have to get lucky with the people that you work with, but for the moment at least I have, for sure.
Yeah, it's very interesting to hear you say that, because when you think about tech companies like us and programmers, they seem very fluffy and happy, and they work together extremely well, and they're all after this common goal, and you can sort of imagine the collaboration. You can imagine it. It seems very material. When you think about a trading floor, you don't necessarily imagine the same kind of cooperation, as it were. But nonetheless, it's something, again, from our research that we've seen is one of the highest priorities in terms of ability. So there seems to be almost a paradoxical sort of...
It is strange, but I think that's maybe because, aside from, with tech, there's just so much, I think the stereotype is these kind of Google-esque environments where there's more emphasis on work-life balance and, you know, other kind of making employees as happy and as comfortable as possible. Whereas banking sadly doesn't have the same reputation. But it's completely flawed to think that teamwork or cooperation, like you said, isn't a big part of it, because if you don't have that, then everything, like I said, everything really just falls apart. So I think it's a really big thing firstly for managers to focus on, to make sure that their teams are running in a way that everyone's actually happy to be there, everyone's working really well together. And maybe because of the threat of tech companies, or, you know, the competition for banks now, I think, is not other banks, I think it's other industries. And I think because of that, I'm sure, as you've seen, because you've obviously talked to recruiters a lot, but there's so much more emphasis on how they can retain junior talent. And the biggest way they can do that is by making them feel happy in their jobs. And it sounds very fluffy and kind of soft, but I think a smaller part of that is the stress on teamwork and collaboration. Because if you have that sort of environment, people are always going to be much happier in the role that they sit in.
One day you'll be referring to your team as your family. Not yet, maybe.
Maybe not yet.
All right, this has been extremely enlightening. I actually wish we could talk more about that. I just want to save a little bit of time to show a few of our new designs and maybe do a bit of interactive market analysis with you. We can talk about. I was going to ask you a little bit about last week and what actually went on and how you dealt with it, but we can probably get to that by thinking about the market as it is today. So I'm just going to go to presentation mode, and this is going to be the end of my face for this particular webinar, which I'm sure will leave all the viewers very distraught. Yes. Hold on a second.
Is it the end of my face too?
We'll see, actually. I'm not sure. Okay. Oh, you're still there in a little box.
In a small box.
All right. So let me just switch over to that. Okay, brilliant. So what everyone is looking at now is just a wireframe. It's not a real website yet, although it has got some functionality built in that mimics a working web app. This is what our new system is going to look like. It's pretty far visually from what we have now, which you'll see shortly after this. So what we're looking at here is quite simply, the dates are from the past, obviously, but it's a weekly forecast of oil, looking ahead about 5 days. So you're making the prediction on Monday for a Friday close. And the form that your prediction would come in, if you look right in the center of the screen here, would be in the form of a confidence interval. So all that means is a range into which you think the price of oil will fall, in this case, Brent crude. So you can see that the pre-selected range here is between $60 and $46. So it's a pretty wide one. Clearly, me in this context has no idea what's going to happen because my range is extremely wide. I'm very lacking a lot of confidence in my view. And equally unimpressive is the rationale that I've attached to that view, which is on the right-hand side, which is unmitigated bullshit, for want of a better word. But that's actually something that you'd get a lot. And this comes from a real Whisper site, or one of these sites where you can find views on what's going to happen. So there's a lot to filter through, as it were, a lot of noise out there to filter through, and you'll see why that's important in a second. Just to explain a little more about this particular page, you can see that the historical data here, up until when the market shuts on the Friday, or rather it sort of slows down towards the weekend, you've got the pulsing live price now, which is since it's in this case like a Sunday, it wouldn't be moving. And then you've selected out of that like the positive gradient and the negative gradient, within which you think the price is going to go. And again, once you've selected that, that's a reflection of your analysis. You then you justify your analysis and explain why you think that. So again, last final thing, there's an analysis period and a voting period. It's quite simple. Everyone does the analysis at the same time and everybody votes at the same time. So when you submit, you'd be taken to like a post prediction screen. So you can see that now we've passed the analysis period. You can't submit one anymore. You're now in the voting period, which is a little bit shorter. And the voting period is very interesting because it's going to unlock a lot of data about your ability to do two things. One is to come up with a rationale that is convincing and compelling and other people believe in, which I think to some extent reflects some of the skill sets that you actually have to do while you're on the trading floor. You have to absorb a lot of information from different parts of the bank, different traders, research, the chief economist, etc., and come up with something that you can then package into a very small analysis for your clients. So this is what we're trying to emulate. It's not the final product, that's why we're just showing you a design, but this is how it works. If you check back on Thursday, you would have seen the price have moved up until there. Now here's the interesting bit. There are a bunch of other predictions that have been submitted at the same time. That's the whole point of the community of candidates on here that are regularly submitting market analysis and rationales. So you can see, this distribution is simply an aggregation of all those views, all those analyses into one. And you can see, for example, that the range that Valor has submitted, if you look on the left, is between around 44 and 55. And attached to his view, which is also very lacking in confidence, a very wide and unspecific view, he's used a geopolitical justification for his bearish view. And let's say it's better than the one that, in this case, I've come up with. If I scroll across, this actually will work exactly like SoundCloud. So as you scroll across, you'll be able to basically go through different views and judge which ones are better, basically. So that's mine again, and then Hatfinch over here, whose view is not so far from mine, but slightly more narrower, and therefore he's slightly more confident. He's again got a geopolitical justification. Over here, the only bullish view of this particular forecast is SB, and he's describing a technical reason for why he now believes the oil price is going to go up from the deadline value, which is this dotted line here. So this is really interesting because if you look through a bunch of views and you upvote the one that you believe is most accurate and you are rewarded for that, then what you are doing is essentially winner picking, which a number of different roles on the within the finance world have to engage in every day. They have to digest a lot of analysis, which comes from different research, maybe their internal research desk, external ones, and then they have to formulate that into an actual position or potentially a view or advice or whatever it might be. On the other side of it, as I've already kind of hinted at, there is the ability to communicate that is being tested here as well. Because if the rest of the group, which are real people, it's not like there's not an algorithm filtering out good views. Real people are betting on your view. They're actually, imagine it like roulette. They're putting some chips on you and believe in what you've said. And so that is testing quite directly the confidence that you inspire in people, or rather the confidence you inspire in people that you understand the markets. Again, trying to emulate and recreate as much as possible some of the roles that you would have on a trading floor. So that's our new design. I should have mentioned this at the beginning, but if anyone has any feedback, comments, questions about this, I would be really happy to answer them. This is what we're here for, basically, to push this out to people and get their opinion. You've heard a lot about what Pria does on a day-to-day basis. It'd be very interesting now to get your views on how this browser version might actually make the application process more fair and more quantitative. Okay, I'm going to switch over now to our existing platform, which looks a little different, but a lot of which is actually quite similar. I'm going to also share this in the live stream. Just give me a second, so you can go on there yourself. Um, if you click through to alpha.fmrank.com. Oh, well, sorry. While I'm doing this, Priya, it'd be great to hear your first impressions. You've never seen this before.
Of the new platform?
Yes, the new one. Sorry, I'll go back to that.
Yeah, I think it's actually, I mean, I have not been told to say this. I actually think it's awesome. I like well, in terms of the interface, I really like the way that you can sort of hover over different, the whole distribution of analyses, and it'll pull up people's rationale within a specific region, and you can actually vote on that. I think winner picking is, as you mentioned it briefly, but I think it's a really important aspect of this. And we kind of touched on it in the Q&A before, but when you asked me, when you're talking to clients, how do you filter all of the information that you get? It's kind of a similar thing in that you're bombarded with information, and you have to find a way of kind of, in your head, giving each one a rank in terms of importance, and then communicating that on to the client or whoever it is internally who you're speaking to. So I think this is a good way to actually get practice in evaluating different people's rationales for why they have put through a specific confidence interval. So I think that's really cool. I think that's new, if I'm not mistaken.
It's certainly new, and I'm very grateful for your kind words. I can confirm that it takes a lot for Priya to say something nice about anything I've done. So this is not something she would say without any, lightly, as it were. Like I said, if you go to the chat now, you can go straight to alpha.fmrank.com, and I would just guide you through that, because we can actually do a prediction right now. What I wanted to do, which we won't be able to, unfortunately, I wanted us to write our own rationales, which we would then put into the comment box on YouTube and then upvote and downvote them, thereby simulating the exact same process I just talked through. What we can do is still submit rationales, but unfortunately, on live events, YouTube doesn't allow up and down voting for completely inexplicable reasons. So let's just put that to one side for 1 second, and then I'll show you how this works. It's exactly the same thing, except it actually functions. Oh, sorry, I'm on Eurodollar right now. I'll go to oil. So the same idea. You can see that going backwards, the green dots are the actual recorded price of oil on a weekly basis, and the yellow is what the group had been predicting. You can jump into one, for example. You can see that's the distribution that it's just been rotated. That's the distribution that the group generated. So for example, if I think, as I do, that over the next 5 days, oil is going to continue on its charge upwards, its rebound, don't let this affect you. I wouldn't use my analysis as a guide, yeah, or as gospel. That's giving it even more credit than I was going to.
I'm saying do it.
Yeah, exactly. So I think maybe now, since we've covered a lot of the important stuff, it would be interesting to just discuss what we think is actually happening in this market. I mean, it is having a disproportionate impact on both other asset classes, finance, and politics, and consumer experiences and consumer ability, purchasing power, etc., than it had done last year, if I'm not wrong. The drastic movements sort of up and down have definitely given it an extra effect. I don't know if you have any thoughts on that.
Yeah, I completely agree. I mean, so a few months ago, the massive, I'm not sure if this is the right terminology for oil, but the sell-off in oil it was huge. We were forecasting at one point for oil to drop below $30 a barrel. I think we've revised it up to 40 maybe, but even that's still incredibly low compared to current levels. But I think it was also the speed of the move downwards that really caught everyone by surprise, and that's what had the biggest spillover to macro markets, which, as I mentioned, is kind of what I'm more focused on. But it sort of comes back to, Arjun, what you were asking me about how much you have to focus on other asset classes and other markets. But when oil has moved like that, going from, say, $90 a barrel to $25 a barrel, that's huge. And that's huge whether you're in finance or whether you're just, person on the street literally going to the petrol station when you start seeing those kind of moves being reflected in the price delivered to the person on the street, that's when you know it's something to really wake up and be aware of, because then aside from having kind of the knee-jerk impact on other macro markets, it'll have a much longer kind of fundamental feed through into the real economy, and then that itself will have a much longer term impact on markets as well, so coming back kind of full circle. So that was a massive deal for our clients. And then at the same time, when you get massive moves like that, whether it's down or up, what happens, and this is a big thing for anyone who's a macro portfolio manager or someone who manages a portfolio of a number of different assets, when you get massive moves like that, when you get high stress in the market, correlations between all of those asset classes move very, very quickly towards one. So I had a client call me and he said, I've got positions in rates, I've got positions in equities, I've got obviously positions in oil too. But right now, no matter what's happening in those individual markets, the whole book trades like it's short oil. And basically asking me, what do I do? Like, can I put on a hedge for this or something? And that's when it gets really interesting, that when you get such big moves in, for example, oil, which, like I said before, it's quite micro, so I actually don't really focus on it that much. But when it's that big, it impacts it has a ripple effect to everything. And then obviously the moves back up more recently have been equally quick and equally aggressive. And I think that's what's been really interesting over the last few weeks, that we've had a lot of news about supply gluts. A lot of obviously producers responded to the massive drop in oil prices by increasing supply, but demand hasn't actually picked up yet. And so what we have is this huge glut of supply across different all of the different metrics of oil, so WTI, but also Brent, which obviously is what we're focusing on. And I think it's really surprising that oil's actually started to rebound so much despite that big glut in supply, which is something that's been focused on so much. Maybe part of it is geopolitical stress, because obviously a lot of oil still comes from kind of the Gulf region. But to me, it's kind of, again, I'm not an expert, so I really don't have a good explanation for it. But then, as you said, Arjun, the rebound has had ripple effects to other asset classes, just in the same way that the sell-off did in the first place. And we've seen massive moves in rates specifically this week, which, as you said, some people are attributing to the rebound in oil. I don't know if that's the case, because there are a lot of other things going on at the same time, but obviously it is a factor. And then when you have clients like mine whose whole books, because of how correlations have shifted, has become short oil, when oil starts to move back up again, then they start losing money on all of their positions. And then that's when we get basically market carnage, which is kind of what we saw this week. So it's been interesting, to say the least. It's really it's quite cool in a way, in a very geeky way. It's quite cool how big moves in one very kind of specific fundamental market can affect macro markets everywhere.
There's no doubt once you get into it, it's very addictive. Just on that point is a great explanation, especially and from your perspective, which makes it even more valuable, from a fixed income perspective. I guess what I'm wondering now, as I'm struggling to formulate a rationale and a specific confidence interval that reflects my view, is we've talked a lot, and there's been a lot of commentary on that almost one-way effect of the oil price on inflation, and therefore reducing fears of deflation, and then the new view is that we're going towards inflation, and then that has a big effect on interest rates, and then potentially on the price of certain sovereign bonds, especially bunds. I'm wondering whether there's an effect the other way, because we're trying to predict oil right now. So is the dramatic scenes we saw with the bunds this week, in case anyone doesn't know, the German bund, which is supposed to be one of the least volatile and safest assets in the whole world, had an enormous move up and down in terms of the yield. So the price dropped and then went back up again on Thursday. And there's just been generally really unprecedented volatility, or rather it hasn't been that volatile for a number of years.
On Thursday, and we've seen big moves in the last 4 years, but I've never had this before. I was trying to get a price from one of my options traders, and these guys are normally quite calm. They're very, their market, they trade volatility, but their market doesn't tend to be that volatile. And this guy was freaking out, and he said to me, look, we haven't seen moves like this since 2008. And that's when I was like, oh my God, something really big is going on. And it's quite, it's quite cool to be in the middle, kind of in the, I don't know what you call it, like the epicenter of that.
Absolutely. Okay, I am going to go with this range of between 71 and around 67. And my reason for that is, oh, I have to log in. Oops, I'm trying to actually set up a new account.
Arjun, you don't even know how to use your own interface.
Okay, all good. My reasoning for that, oh, we've got an interesting distribution already, actually.
That is really interesting. I would be interested to know why it's so skewed that way.
Yes, indeed. It was actually not very Gaussian, as in it's there's a specific clustering around between 68 and 70, which means that people may have read the same article I read, which I thought was very interesting, which was around the threshold at which production becomes profitable for the shale producers in the United States. Now, that's most of the conversation around oil has revolved around what's going on in the US and how many of them are going bankrupt, how many of them are cutting their rigs, etc. I mean, we're talking about real fundamental things here, but they're not that difficult to understand. They're just, it ultimately just comes down to, is that supply going to match demand or vice versa? And just one stat I read today, which seemed very convincing to me, was that there is a certain threshold between $65 and $70 at which the CEOs of all these companies say, okay, let's turn the tap back on. We can start producing again. And so that seems interesting. It's not like a psychological threshold, like $100 or whatever, which I'm very skeptical of, even though it seems to be mentioned. It's a real threshold, based on the systems they have in place. They're actually much more efficient than the oil extraction sort of processes that you see in maybe OPEC countries. But nonetheless, they rely on a certain oil price. And so my view, to summarize it in 140 characters, is that there is a ceiling around $70, because obviously if it reaches that point and then supply goes up, because it's reached that point, then I'm expecting it to stay around there. So that's my view. I might be completely wrong. I don't know how many people would upvote me if that was on our system. But like I said, it's great to see that some people are getting in.
Am I allowed to ask you a question? Am I allowed to challenge your view?
No. Yeah, no, of course you are. Go ahead.
I have no strong view on this, but just playing devil's advocate. If this is, you're predicting where Brent will close on Friday, next Friday.
Yes, exactly.
What is it that takes Brent to that threshold by Friday?
Well, that is a very good question, and my answer is that it's a trend. I think a number of big market participants have been unwinding their positions, as far as I can see. I'm looking at the trend line. It's quite interesting, actually, that just looking at it using our system, because it only shows like the weekly prices. You maybe get a slightly different view than if you saw the volatility in between. I think there's a general sort of consensus, and this is purely me judging the mood, which I think is actually very important in this kind of assessment. That it's
sure.
Yeah, exactly. That it's on a slow rise, but I think that then that will eventually be affected by a real fundamental reason, i.e., the supply. But that's really interesting, because what we've sort of uncovered here, and neither of us are oil traders, neither of us pretend to be, and we would never say that our views are sort of very accurate. But we've uncovered a interesting split between a fundamental understanding and then one that's more based on a sense, more based on a sort of looking at what's going on. And sometimes people call this technical trading. I wouldn't go as far as saying it's technical in any way, or using like a K line or something like that. It's purely, I feel like the general mood is that it's on a rebound, but then it will reach some kind of ceiling within that rebound.
Mm-hmm. I think you can also use, as part of that sort of sense, like you call it, you can use intuition from, I feel like I sound like a broken record, but intuition from other markets as well. So yesterday we had US data, which came out. It was kind of slightly disappointing, a little bit weaker than expected. And that triggered a pretty decent sell-off in the dollar, because obviously that meant with the weaker US data, then people price out the Fed hiking. So if the dollar weakens, I mean, this is just me, and again, I have no view on oil. I don't know much about it. But if the dollar weakens, then in the short term, that should be bullish for oil as well, because it means that for non-dollar based customers, so anyone outside of the US, basically, it's cheaper to buy oil. So that was kind of, I was trying to think about it when you asked before, and that was sort of my rationale. But again, I've got no idea if it's...
No, I like it. I mean, obviously, I'm completely ignoring the dollar denomination and the effect it has on commodities. This is exactly the kind of thing I would hope to learn when I went to see the rationale page and saw other people's rationales. And then maybe next time, if I turn out to be completely wrong, then I might try a different approach. And that actually ties quite closely into a secondary value of our system, which is related to, it's not just about proving yourself. It's not just sort of a ruthless ranking system. It's also extremely educational. And it is really the learning by doing aspect. I've learned from this conversation now that we're having, and we're just having a qualitative discussion about oil. We would never do this if it wasn't in the context of financial market rank. I've actually heard from a lot of people who, and this actually relates to a point you made about widening the net and not necessarily knowing everything when you get in there. I've talked to a lot of people who have used like our basic systems, and they didn't really have that much of an interest in finance to begin with, or let alone markets specifically. And it's actually through this sort of game, this sort of process, that they've discovered they find it really interesting, the ebbs and flows of the market and where it's going and the effect it has on politics, etc. So we are hoping to massively widen the net of talent by giving them a way in that doesn't involve going through a 3-hour application, which is a big commitment. Obviously, this is a small commitment, and we've seen also just from Myriada, not just financial market rank, our existing previous system, that people get very addicted to this. I think some of that addiction is similar to what you would get if you were a day trader. There's no doubt about it. But we're obviously visualizing and showing movements in the markets and people's views in a very different way. And there is also that level playing field aspect, which is quite cool, where because the money element is divorced, it's purely about like forming a view and then imparting it. It's a much clearer way of measuring yourself against other people. I think we're getting towards the end now. I'm going to switch out of this. I'll just go back to it for the end. Okay, so we have a confirmation that it will be $67 next week.
We have confirmation.
That is the group view. Hold on a second. I'm going to get back in. Here I am again. I promised it was the last time you'd see me. I'm sorry, I lied about that. It's been fantastic having you on here. Your answers are incredible. I'm going to have to re-watch this webinar so I can digest it a little better. I was focusing a lot on what I was going to say next, obviously. One thing I've noticed that no one seems to have commented about is that we're hosting an event about interpersonal finesse with a very talented hotshot from Goldman Sachs. And we have the HSBC logo, a bit of product placement there.
Let's pretend that one's not there.
And also what looks like the Deutsche Bank logo above your head, although maybe like a contemporary artistic version. So that was just a little bit of irony that I thought was funny. The irony that didn't happen was that we didn't stumble too much on our interpersonal ability, which would have been very ironic, I think.
Yeah,
we did okay. Sorry about the beginning where I had you on mute. That was pretty foolish of me, but otherwise,
well, thanks so much for having me. And I'm really curious to hear what your viewers, whoever's watching this, actually thinks of the platform, what they think about the moves in oil, what their reasoning is for where they place their predictions, but more importantly also whether they think your platform is a really good tool, which I think it is, for finding out if you care about markets. Because if it's being used as a recruiting tool, you don't know until you actually get into this kind of seat whether you care about markets. So having something that allows you to figure that out is really cool, I think. It's really important. I
appreciate that. That's very good of you to say so. We've had some quite funny comments here, actually.
Oh, really?
Oil is going to collapse with the dawn of hydrogen-powered cars. That's
I didn't know hydrogen powers were coming next week.
We shouldn't laugh at people's views. I mean, you know, there's no downvoting here or upvoting here, but
you know what? On the training floor, people will laugh at you if they don't like what you say. So maybe it's good practice.
I appreciate it genuinely, Mr. G. Lily White, for getting involved. The other comment which I thought was amusing, which I didn't say earlier because I wanted to keep it serious, was FM Ranker, which is interesting. Asked if you have a boyfriend. I can tell you, FM Ranker, that she does. I'm very sorry about that.
Sorry.
I won't denigrate our guest with that kind of question. But thank you again for being involved. Priya, I appreciate it enormously, and I'll keep you up to date with everything we're doing. And we will host another event. It won't be this kind of Skype event. It will be a webinar, which is broadcasting an actual event, a physical one. I think probably a month or 6 weeks from now. And we'll have a guest who will have a lot to live up to provide the same level of information and insight that you did.
Well, I look forward to seeing it. And yeah, thank you for having me.
Perfect. Okay, thank you, everybody. Good evening.